30 U.S. banks halted and 6 under review. From Reuters.com, Moody's downgrades Signature Bank to junk and places 6 U.S. banks under review. Ratings agency Moody's on Monday downgraded the debt ratings of collapsed New York bank Signature Bank deep into junk territory and placed the ratings of 6 other U.S. banks under review for downgrade. And from RepublicWorld.com, complete meltdown in U.S. markets, trading in over 30 banks halted over shares slump. The collapse of the Silicon Valley Bank after a failed capital raise has triggered concerns among investors about risks to other banks from sharp rate hikes. Trading was temporarily halted in dozens of regional American banks on Monday after shares slumped following the collapse of Silicon Valley Bank. The volatile condition of the American market led to trading in roughly a dozen banks being halted. While the market saw a massive drop in the stock prices of several banks, the shares of bigger banks seemed less affected but not completely immune. The stocks of the U.S. regional banks plunged on Monday as investors reassessed how much such lenders were worth following the sudden collapse of Signature Bank and Silicon Valley Bank, the New York Times reported. According to U.S. media reports, trading in shares of Silicon Bank's peer Signature Bank, First Republic Bank, PacWest Bank, and several others was halted. Trading halted in at least 30 banks as markets opened on Monday morning. Reportedly, Arizona-based Western Alliance stood out as the worst mover on the day, down 80% in early trading. First Republic Bank tumbled 75%. Utah-based Zions Bank Corp fell around 20%. Comerica tumbled 30%. East West Bancorp 30%. Regions Financial, headquartered in Birmingham, Alabama, was down around 10%. Notably, the sudden collapse of the Silicon Valley Bank after a failed capital raise has triggered concerns among investors about risks to other banks from sharp rate hikes. Following the collapse of a Silicon Valley Bank, the U.S. government debt markets experienced their biggest move since Black Monday in 1987, which was one of the most severe market crashes on record. The bank's collapse is being seen as the biggest retail bank failure since the 2008 global financial crisis. Biden urges Americans to have confidence in banking. Amid the scare among investors after the massive plunging of shares of several American banks, President Joe Biden on Monday urged Americans to have confidence in the country's banking system and said that the nation's financial systems are sound. Americans have confidence that the banking system's safe. Your deposits will be there when you need them, Biden said. Biden's statements came after U.S. regulators closed the Silicon Valley Bank on Friday after it experienced a traditional bank run where depositors rushed to withdraw their funds all at once. And this from We Profit Day and Night.
There had just been a government bailout of Fannie Mae and Freddie Mac, and fear was rising over Washington Mutual after the S&P cut their credit rating. At the same time, Lehman Brothers had just filed for bankruptcy. Lehman shares dropped 94% on that day. Now, what made that day in September so different from March is that, unlike with Bear Stearns back in March of 2008, the government was not willing to help finance a takeover, bailout, or restructuring of Lehman Brothers. They just let them collapse. So what you have to understand from history is that so long as the government steps in and provides either a takeover, a bailout, or some sort of restructuring in order to help one of these companies that's going bankrupt survive, if that happens, the stock market's fine. It might drop a little bit, but it usually recovers. But if a bank collapses and the government does not step in to bail them out, that's when we see a massive crash in the stock market. So now let's get to 2023 and talk about what's happening with Silicon Valley Bank and whether or not the government or some magical buyer is going to come in and either take them over or bail them out. Now, before I get to all the news that came out Sunday night to kind of explain what's happening right now, I want to take a quick look back at Friday and really all the way back to Wednesday to understand how the bank collapse of Silicon Valley Bank actually went down, because this was the second biggest bank collapse in U.S. history. Now, a ton of people have already come out and explained exactly what happened. I'm just going to give you a very, very short narrative. Essentially, as a lot of money got deposited into SVB Bank over the past few years, they had to then go and buy some mortgage-backed securities as well as U.S. Treasuries, and it makes some profits off of those. So essentially, SVB would go and they would get maybe 1 or 1.25% interest from these mortgage-backed securities and these treasuries, and then they would pay maybe 0.25% interest to the people who deposited money at the bank, and then that extra 1 or 1.25%, they would just hold that, and that would be their profit. Now, all of that's fine. There's no issues with that at all, so long as people don't pull their money out of the bank. Now, if people start pulling money out of the bank, then the bank has to go and they have to sell those mortgage-backed securities and sell those treasuries in order to pay back the money that the customers are withdrawing. And all of that's fine as well, so long as they're able to sell those securities for close to the same price that they originally had bought them for. Where the problem lies, though, is when the Federal Reserve does massive interest rate hikes. When the Federal Reserve starts raising rates, their little 1% bonds suddenly are worth a whole lot less. And that's because if I'm a brand new buyer of a bond, and I know that I can go and I can buy a bond for 4% from the government, and then Silicon Valley Bank is over here offering me their 1% bond. Well, I don't want to get 1% interest when I can just go to the government and get 4% interest. So in order for Silicon Valley Bank to entice me to buy their bond, they have to lower the price. So maybe they paid $1 for that bond, but in order for me to buy it, I might only be willing to pay maybe 75 or 80 cents for that bond, since it pays a much lower interest rate than what I could get by going directly to the government. And that's exactly what happened. As people started pulling money out of Silicon Valley Bank, they were forced to go out into the open market and sell these bonds that they had bought years earlier. Problem is, they'd bought the bonds for around $1 and they were selling them for around 75 to 80 cents, meaning they were losing a ton of money. By Wednesday, the bank had already lost $1.8 billion, and they were seeking $2.5 billion in loans in order to shore up their balance sheets. Unfortunately, they were unable to find a loan. They then tried to go find a buyer for the bank. When that failed, by Friday morning, the FDIC went in and shut them down. Now, what's important to understand here is that in the news, in the media, you're going to hear that this was a one-off. This was a unique situation. This was a hysteria-induced bank run caused by venture capitalists. This is not going to spread to other banks. It's a one-off and every other bank is fine. Now, that's the narrative you're going to hear. And the reason you have to hear that narrative is that the government doesn't want people getting fearful that other banks might be in trouble. So the government's going to come out, they're going to say anything they can, they're going to do anything they can in order to quell the fears so that we don't end up with another 2008. But as we all know from the Bear Stearns fiasco, everything is not fine with all of the other banks. From 2008 to 2014, more than 500 banks failed. The largest of which was Washington Mutual, which everybody had fears about around the same time that Lehman Brothers collapsed. And if you look far on the right, you can see that Silicon Valley Bank was pretty close in assets and deposits compared to Washington Mutual when they went under. This is a major, major collapse of a bank. And what ultimately caused this was a massive bank run where people got fearful that the company was running out of money. They didn't have enough assets to match all of the deposits. People went and withdrew their money, and in no time, $42 billion of withdrawals were attempted, and this completely crashed the bank as they had to go sell those mortgage-backed securities and treasuries at huge discounts.
And from Meet Kevin.
Startup. So yesterday, the Federal Reserve U-turned and issued what was essentially a de facto 100% bailout of FDIC, even though that's not technically the way it works, because we have a new BTFP facility. Yes, it literally sounds like, or seems like it would stand for by the effing pivot facility. It has its own particular name. That's not the actual name, but we'll just pretend it is because it's funny. But anyway, that's the Federal Reserve's program for providing $25 billion of Federal Reserve-backed liquidity to make sure that banks can go to the discount window at the New York Fed and basically hand them toxic assets, and the Federal Reserve, apparently without discounting those toxic assets, will give them money. Make no mistake, that is a bailout. Now, Joe Biden will be speaking and talking about how, don't worry, your money is safe with the banks. We have backstopped all reserves at banks. All deposits are safe. You don't need to go close your bank account at your local regional bank or your credit union. Fear not, because look, we are protecting all depositors. Don't worry that 3 banks have just collapsed in a span of 5 measly days. Don't worry. Everything is fine. And I hate to say it, but when people tell you everything is fine during a banking crisis, I hate to say it, but sometimes I think thou protest too much. And I think that's the same thing that's happening with First Republic. First Republic yesterday let everyone know, don't worry, we have $70 billion in liquidity. We're fine to cover deposits. Their stock this morning promptly down over 60%. After all, Silvergate closed on Wednesday. Silicon Valley Bank went into FDIC receivership on Friday and is being liquidated. No buyers showed up, so on Sunday, the Federal Reserve had to come out and U-turn to bail out a bank. And I understand, they do not want you to think this is a bailout, but make no mistake, it's a bailout. And then at the same moment, Signature Bank collapses. That's a real estate lender who focused on wealthy clients but made a failed crypto bet, and now the government has taken control of that bank as well. That's 3 banks down in 5 days, but don't worry, the Fed says everything is okay. There's nothing to worry about here. I don't know, folks. To me, I think there's a lot to worry about. And that kind of worry is what you're seeing show up in the market. The market does not seem to believe the Federal Reserve when they say this isn't a taxpayer-funded bailout. After all, the Fed is trying to clarify that this is just a loan to banks. And if there are any losses, don't worry. The other banks will just pay a special FDIC fee to cover those losses. I don't know about you, but that sounds a little bit like banking socialism to me. Oh, one bank failed, we'll just make everyone else pay their fair share of that bank making risky moves. And I think Jeffrey Gonlock, who's a pretty big bear right now, makes the best argument. He says, quote, "So if I have this right, the Federal Reserve will make loans on some of the collateral at a par valuation that is worth 40% less. Yikes." Let me simplify that so you could see what the Fed is basically doing as Jeffrey explains it here. And then you tell me if you think this is a bailout or not. Because the government does not want you to believe this is a bailout. If a bank goes to the Fed, so here's the bank and here's the Fed, and we'll call this the discount window right here. And here's the banker. And the banker says, hey, I've got this note right here. The note says it's worth $10, or we'll say it's $100. The note says it's worth $100. Don't mind the fact that it's actually lost about $60 of its value in market value. So don't mind the fact that this is technically only worth $40. Don't mind that at all. Will you take this toxic asset in exchange for $100 in cash? And the Federal Reserve is saying, yep, looks good to me. Here's $100. You're good. We'll take your toxic asset, really only worth $40. But we'll tell the American people it's a 1-for-1 transaction because we don't want the American people thinking we're bailing out Silicon Valley. That'd be crazy. We don't want that at all. Now, then some people say, oh, but Kevin, this is a facility that set up $25 to $100 billion of money back during 2008, and they've set this facility aside for emergencies in the future. Well, all you have to do is go to the left-leaning Washington Post to realize who actually backstops that facility. It's the American taxpayer. So, anybody...
And Matt Stoller on Glenn Greenwald.
Of the deregulatory choices and bad regulatory decisions by the San Francisco Federal Reserve. But another reason is because they just didn't have the assets they needed, right? The Federal Reserve is a bank of banks. And if you need a bunch of cash, you can just go to the Federal Reserve and say, I have a bunch of treasury bonds or loans or mortgage-backed securities or whatever. I need to borrow from you. I'll give you these as collateral. You give me cash. I'll give it to my depositors. When things blow over, they'll come back and redeposit the money. And that we have a system that's set up to deal with large demands for cash. The reason Silicon Valley Bank couldn't take advantage of that system is they didn't have the necessary collateral because they were insolvent. Most of these regional banks are not insolvent. And also, most of these regional banks are funded by insured deposits. So people with less than $250,000 who have no reason to move their money. Silicon Valley Bank was funded 97% with uninsured deposits. Signature Bank, which is the other one, that was Barney Frank's bank, and Ivanka Trump was on the board of that one before Barney Frank was. That was 90% uninsured deposits. The next most likely bank to fail, which is called First Republic, that has about 67% uninsured deposits. And from there, it goes way down. So we're really not dealing with a system that is, yeah, there's some trouble because the Fed keeps raising rates. But as you put it, the Fed has telegraphed this. These guys just chose not to hedge because it would actually their own employees were telling them, you got to hedge. This is really dangerous as interest rates rise. And the bankers were like, we don't want to. We won't make as much money. So they were making these choices. They were remitting some of the extra profits to the uninsured depositors in the form of, what I've said before, these quasi-bribes. And they're a pretty unusual bank. Most regional banks are not like this. So you might have an initial panic. You might take down 1 or 2 or 3 other banks, but it'll blow over. And then you will have reimposed market discipline. Instead, what we did is we said, everyone's going to be made whole. Silicon Valley Bank depositors who took these massive risks, they're going to be made whole. All banks except for Silicon Valley Bank and Signature, their funding costs are going to go down, and we're going to hand them all the full faith and credit of the United States that they can go off and gamble with. And there we go, problem solved. That's what we did instead. This is just like a panic, and instead of dealing with banking panics, which is the way that we should, which is to just use take out the bad banks that are insolvent, you let them go insolvent, and everybody else, you lend them to tide over the panic. They freaked out and did a giant bank bailout. And I'll say the reason this is different than 2008 is there are losses on the books.
Hold on, Matt, hold on, before we get there, I just want to address my audience for 1 second, because people are telling me in my ear that they're treating you and cheering for you like you're some kind of Huey Long populist and wondering why I've suddenly transformed into Tim Geithner performing propagandistic services on behalf of Silicon Valley oligarchs. So I just want to be very clear that the format of the show, on purpose, and I thought I said this at the beginning, was I was going to have Matt on, who I know for certain is somebody very vigorously opposed, in fact, angrily opposed.
All right, we'll be back with more news.